Hey, good morning, everybody. How was your weekend? Cool. Okay-ish. I did one interesting thing that I hadn't done before. I volunteered for charity, and I woke up at like 5 o'clock in the morning on a Saturday and helped cook 3,000 chickens. Yeah, only 3,000 chickens. Man, that was a lot of fun. All right, so hey, let's get going. Uh-oh. Webinar not working. Hang on, let's see. Oh, there we go. All right, hey, my name is Wayne McDonald. I'm the Chief FX Market Strategist for TradersWay.com. It's an ECN that allows you to trade Forex, energies, metals, indices, and binary options. How cool is that, huh? We do these trading sessions every single day here at Forex.Today. We start at 7:30 in the morning, and we go to at least 8:15, sometimes 9:15. We do that Monday through Thursday at you can log in through your private office at TradersWay.com. You can go through Forex.Today. And then every Friday, I do a similar session at FXStreet.com. So today is a Monday. Boop, boop, doop, doop. Yep, it is Monday, the 14th of September, 2015. This is the big Fed week, where the Fed is going to surprise everybody and not raise interest rates. But we still need to get together and talk about it, don't we? So I'm going to do a special event for clients of TradersWay.com. If you have a live account, even if there's only $2 in it, you're welcome to join me for this special trading session. So I'll send out an email about that. Don't you worry about it. Take care of you. What do you think? Does that sound like a good idea? Do you guys want to get together and trade the FOMC announcement? Yeah, my guess, if I were to guess now, like you were forced me to guess, I'd say they don't do anything. Dollar gets weak, euro goes straight up like a rocket ship. Cool. We could talk about that later. Now, the one thing that we tend to do on Mondays is go through the Commitment of Traders report, which is located here on Forex.Today. By the way, it's early in the morning, and it's the 14th, right? So there's 1, 2, 3, 4, 5, 6. There's at least 6 trading ideas: Euro USD, Pound USD, USD Yen, Euro Yen, USD Yen, and a USD Swiss franc. Cool. And some of these are actually posted probably before midnight. Yeah, so they're 14th as well. They came on the 13th. So anyway, so we're looking at 14th. Yeah. So look, man, there's over a dozen trading ideas right now at Forex.Today. Cool. And what we'll do is we'll go over to news, and we'll go through the calendar, and we'll look at the other event risks on the calendar this week. Risks, or maybe even opportunities, huh? Wink, wink, nudge, nudge. And then we'll go through the Commitment of Traders report, which is an institutional report gathered by the Commodities Futures Trading Commission of large orders in the market by institutional players. I mean, I guess you don't have to be an institutional player, but if you have $1 billion in a currency trade spot position, it's going to be listed there, but usually it's an institution. So how does that sound? Does it sound like a good day? Look at you guys, you're talking about somebody. I don't know who that guy is, but apparently people don't like him, so I'm glad I don't know. Cool. Hey, so let's get going, eh, babe? By the way, you look good. You working out? Let's get going. Yo, 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 yo! Trading and investing is risky. Good or bad, your past performance is not indicative of future results, but you know what? Psst, psst. Stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. I should also comment that making big money is a byproduct or a potential byproduct of taking big risk. And on the long run, taking big risk will blow up your trading account. And if you're trading other people's money, you'll end up being buried somewhere between Abu Dhabi and Dubai, out in the desert somewhere, because you gambled someone else's money and lost. So one piece of advice, especially if you're just starting to trade real money, pretend like you borrowed the money from your father-in-law. And then imagine going to your father-in-law and saying, sir, I lost all your money. That would be a good conversation. So you got to be careful because, a lot of amateur traders, what they say is, I'll try this Forex thing. I'll pop $5,000 into a trading account. And if I lose that $5,000, well, at least I gave it a try and then I'll go take that options course. No, it's not okay to lose the $5,000. No. Marina says YJ's pound yen trade is spot on, huh? Right on. Yeah, YJ's good. Is it on here? Oh, he kept it for himself? Oh, it's a secret trade? Yeah, I don't see it. It must have been from Friday. Oh, everyone's like, no, it's there. Everyone knows it. Right on. Wow, got a page. Yeah, a Friday trade, huh? Cool. Let me go through. Oh, it's so far. Is this it? Is that YJ? No, that's Kate. Aussie yen. Wow, we have to way back to the. Oh, there it is. Here's YJ's trade from Friday. Yeah, that's pretty clear and concise. Kick off a pivot and a moving average. Sweet. That's a really good post, YJ. Very detailed, very well written. That looks great. Good job, YJ. By the way, if you want to follow YJ, I believe you can do it. Click on his name. And is there a way to follow it? Maybe not. I'll have to create something. There's YJ's trades. Cool. All right, well, hey, let's get going. What did we say we were going to do? Where am I? What time is it? All right, let's do the calendar first. Yeah, no, YJ, that was quality. I could see you didn't just bang something out. Very well done, very professional. All right, so let's get her done. I should say while we're filtering the calendar down, I should say the closer we get to the Fed announcement, the more that the market's going to get thin. All right, there's no logical reason to be taking on giant risk right before giant risk. You understand? So you should always bear that in mind. Okay, the RBA is going to do their thing. BOJ is going to do their thing. Very important. Here's my guess. BOJ doesn't do anything, but they're not going to make a change in policy. But are they hitting their numbers? Are they doing well? No. So there's no reason to cut back is one part of the logic. And then the next part of the logic is they might need to do more. And they've been talking about it publicly, right? So the meeting later, which is what, end of October or something like that, I think they're going to add some QE or some sort of stimulus. Or so what they did the most recent change that was announced in Japan was, I don't know if they passed it, but but there's at least talk about cutting corporate taxes, right? Cutting taxes is good because the way they screwed up their economy, remember this. I was so thrilled about the tenacity of the Japanese people to fix their economy. I thought it was the most brilliant thing I've ever seen. To change the leadership at the Bank of Japan, to change the leadership at the Prime Minister level, to change the leadership at the upper and lower houses of Parliament in Japan, and everyone working together to achieve one goal, to fix the Japanese economy. Most brilliant thing probably I've ever seen from elected officials. And then what did they do? They jacked up taxes and screwed up the whole thing. I mean, one of the most epic fails that I've seen, and it was terrible because there was so much wonderful hope. I mean, I really thought they were going to do it. Just wow. Because I think about the United States of America that couldn't pass anything if their life depended on it. So to get together and agree and to have one goal for all parties, wow. So just massive epic fail. So to start at least talking and then potentially cutting corporate taxes, well, at least now we're kind of going back in the right direction. But just amazing to me that you would do quantitative easing and then raise taxes. I mean, then what's the point? You're just throwing the money away. So at least they're moving in the right direction. But so I'm thinking maybe the October meeting, they do some QE or stimulus or cut tax, probably just more QE. But at some point you got to get nervous about that, right? Now the United States, if you look at debt, the United States is 50% of GDP is how much the debt is. In Japan, it's more than 50%. Who knows what the debt percentage of GDP for Japan is? The United States is 50% of GDP is our debt. 250, 290. Wow, you guys are smart. I was guessing it was more like 200, but 250 is believable. So I guess it always comes down to how you calculate what each one of these numbers is. But yeah, you guys are right. 250, 290, 200. I'd accept all of those. So this is where they say, oh well, America is drowning in debt, and that the world is going to stop using the U.S. dollar as the reserve currency. Really? Because that just sounds stupid. Right? That's just like a big red flag that says, I don't know what I'm talking about. I don't know what I'm talking about. All right. So anyways, very interesting. They need to do something. But printing more money, I don't know if that's going to be it. See, if you are the reserve currency, you can print your own money, and what's cool about it is your debt also gets devalued. That's not the case for Japan, but so anyways, that I got my eye on that. Oh, did Goldman Sachs call you today? Tell you their outlook? Are you a client? Yeah. Did Goldman Sachs call you? No. That's so last Friday. So Goldman Sachs says this morning that they believe the Euro USD is going to go to 130. Yeah, is that helpful? So Stephen asks a very good question, the ultimate question. Why? Well, just the way that everything's structured right now. I mean, I've been saying that for 2 years, but yeah, it's just simply Japan's doing quantitative easing and is likely to increase quantitative easing, like I just spoke about. In the United States, whether it's September, late October, or December, or even next January, February, whatever it is, whatever the case may be, the United States is likely to raise interest rates soon. That's it. That's what I'm trying to tell you. It's all central bank policy, guys. I don't know why you fight me on the fundamental stuff. They also said the euro is going to collapse. Why? Well, because the ECB is doing quantitative easing. I mean, that's it. There's no more discussion. It's just where you decide to sell or where you decide to buy. All right? That's why we discuss it. That's why I'm here, babe. Now, Thomas says equity markets. You know, we could have a great debate over this one, and I'm a master debater. And I used to have these conversations with our old quant, Kurt Worley, and I don't know if he and I ever agreed, but we're both right, and at the same time we're both wrong because there's no real way to prove it, but one possibly leads the other. Like, that's what correlation is, right? So add quantitative easing, the stock market goes up, but does the stock market go up and make quantitative easing? No. Why does the stock market go up? Well, because quantitative easing is designed to increase asset prices. Well, what the heck does that mean? That means the currency gets devalued and the stock market goes up because now if the dollar, if it's in US dollars, right? But it could, whatever currency, peso, right? If the peso goes down in value, then more pesos are going to be required to buy the same goods and services. And now the corporations get to report that they made more money. But think of it, if the peso went down 10% to keep everything at the same level, the amount of currency that's required to buy that same basket of goods and services would likely go up 10%. So now the company says, well, we made 10% more money. If it was a car company, you'd say, well, great, how many more cars did you sell? Oh, we didn't sell any more cars. Right? But revenue went up 10%. Like, no, your currency was devalued by 10%. So, but whatever, asset prices go up. But also it squeezes you out of other things, other investments, and the only kind of place you can put your money is in the stock market. But just understand, like, quantitative easing by design is created and used as a tool to make the stock market go up. So, I think the horse on this one is the QE, and the cart is quantitative easing. But hey, if somebody says, yeah, I think we're going to start doing quantitative easing, buy the stock market that day. That's it. Done. Fundamental analysis. Now, the technical analysis, if you kind of want to discern the difference between the two, fundamental analysis helps you understand the trend and the change in trend. Okay? Doesn't put you into a trade. But you'll hear from me, like the examples I've given a lot, where I was bearish on the US dollar for years, probably 2 or 3 years straight. And then on one moment, on one particular morning, which we knew was coming, something changed at the central bank. And that moment, I immediately said, I am now a bull on the US dollar. I've been a bear for years, but now I'm a bull. And the cool thing is, I could talk about it 2 or 3 months before it even happened. But I'd say, I'm still a bear, I'm still a bear, I'm still a bear, I'm still a bear. Policy change occurs, boom, I'm a bull. And I'll be a bull for years. Now, that's fundamental analysis. But it still doesn't put me in and out of a trade, and that's why, technicians use price and time data, discern things like, you use an algorithm, or, in this case, like a technical indicator, you might use a MACD or stochastics or moving averages, and what you're trying to identify are things like support and resistance, which are just good places to buy and sell. You want to look for overbought and oversold conditions. You want to line up multiple time frames, but at the end of the day, the trend is the trend, and that is fundamental, and that's that. But you can still screw it all up, right? So I think you should have a healthy respect for both technical and fundamental analysis, and I've always thought that. All right. So Fundamental analysis is basically the analysis of trend, why the world works the way it is. And then the other side of that is how do you get in and out of the trade? Right? If you're a bear, sell when it's overbought and then let it drop. That's it. But I think if you can master those two things. So, coolio. I guess I should mention the site. Do you guys, if you're going to learn more about fundamentals, let's see, what did I call it? Was it training? Training.fxbootcamp.com. Trader's Way has sponsored a training course for you if you want to learn more about fundamental analysis. And they give, because of their sponsorship, if you have a live trading account, you get a coupon code for 51% off. All right, so that's training.fxbootcamp.com if you want to learn a lot more. Just be warned, it'll be about 20 to 24 hours of videos. There's only 15 hours of videos there now, so I'm adding some more. So right now I'm doing one on balance of payment and balance of trade. Doesn't that sound sexy? You guys want to analyze balance of trade data? Cool. So that's that. All right. So let's go through it. So again, RBA and BOJ. Okay, probably nothing new, but still very interesting. And then the British pound. Yeah, British pound is interesting. Fundamentally, you know, we're thinking January, February, March, they raise interest rates. But there's a lot, like Wheel's been talking about it publicly a lot lately, like get ready, we should raise interest rates now, you know, that kind of stuff. So just keep an eye on that. But what we need to see is the start of good data, and most of the good data is going to appear by bad data falling off the analysis. So whatever, a good number would be good for the British pound. But if you notice the tug of war, British pound goes up, and then it comes down, right? So, like looking at British pound right now, it over the last 3 or 4 days, it's had a good, you know, higher high, higher low, higher high, higher low, higher high, higher low. But what did we get now? Double top, probably a lower low. Why is that occurring? Well, on the daily chart, it's run into moving average resistance as well as price action resistance, so keep an eye on that. All right, so ZOO out of Germany. It's not going to be good, so don't worry about it. What matters is we've already set everything in place on the euro, so it doesn't really matter. What do you think a number is going to come out so good on the German ZOO that the ECB is going to stop quantitative easing? Does anyone think that that's possible? They're expecting 25, but it comes out 125, and the ECB says, "Oh, whoa, hold your horses," right? Not a million years. So I'm like, all right. Typically, normally, German ZOO, very interesting. A good number would be fine. We don't want to see a bad number, really. I mean, just to save the rest of the world, right? I mean, if you want a bad number of the euro, what you're saying is, maybe the Eurozone never recovers. Maybe China never recovers. Maybe Australia and Canada never recovers. Maybe Japan never recovers. Well, then what the heck happens to the United States? All of a sudden, we're in a global depression again, right? So, no, I don't want to bet against them, but a good number is welcome, but it's not going to change a dang thing fundamentally. Retail sales, core retail sales, all that kind of stuff. Well, this is really good because we have a consumer economy. 60 to 70%. So we want to see good numbers out of retail sales, just to, you know, to show that that part of the economy is alive. All right. So China is trying to build a consumer economy, and they just can't do it. So it'd be nice if the United States had one, right? To show that the U.S. is still the big dogs. So retail sales would like to see a good number, but again, is that going to change the inevitable that the Fed's going to raise interest rates soon? No, probably not, but you don't want to see a bad number, But, here's the thing. If it was a ripper good number, it comes out way better than expected. Fed watchers are going to say, oh, the Fed has to raise interest rates now, which of course is nonsense. Maybe it sells newspapers or something, but you'd get that, and you'd probably get a spike in strong dollar because people wouldn't be trading the retail sales. They'd be front running the Fed, right? But I don't like to think that way. Remember, the Fed can do whatever they want, and they'll usually do something to show that they can do whatever they want. So anyways, keep an eye on that. Let's go to Canada. I'll just skip right past the UK stuff again. Manufacturing data out of Canada. Okay. Negative 3% year over year. Yeah. All right. Probably not a good number. Okay, US CPI. Again, a very nice, important measure of inflation levels in the United States. We're not likely to have any. Look at this. Here's what's expected. 0.2% inflation year over year. 0.1 month over month. Now, here's the interesting thing. Like the Fed, I believe Janet Yellen said she's going to do it this year. And when I look at the data, I still don't see the need to raise interest rates. So what I've been saying for over a year for sure is that the Fed should not raise interest rates this year at all. I don't think we should even be talking about it. We talked about it all year. Do you remember when and I kid you not, like on CNBC, they said that there was 100% chance that the Fed had to raise interest rates in February. It was just dangerous of the Fed to wait so long, and that they're going to screw everything up like Greenspan did. Remember all that kind of stuff? I said, that's just dumb. What a dumb thing to say. Now here we are, 9 months later, and they're still not raising interest rates, and everybody thinks they're going to do it. And I believe Janet Yellen said she was going to do it sometime this year. And I get the idea that December might not be a good month because it's the end of the year, and half the employees have gone on holiday. So like, is it October? Like, okay, maybe. And if it's October, I don't see why. If they're quite certain they're going to do it in October, which is probably not the case, well, you might as well do it in September. What's the difference? Doesn't make a difference. Do it in September. Who cares? But the thing is, I look at this, and I see the problem. 0.2% year over year. But what's the target? Two. We're 90% away from the target. And do you jack up interest rates because you're cruising at target? No, you should be over your target, right? You're like, whoa, right? Whoa, 3.2? Oh, better raise interest rates to slow this economy down. Not if it's like 1.9 or just barely clicked over to 2.0. I mean, I don't know, man. So, well, right, Marina says, the low interest rate isn't helping the economy at all. And I agree with that. But because of the anticipated change, because the market's been so wrong on the Fed, and I don't know why. The Fed's incredibly transparent. But the market's been so wrong that the dollar has been way overvalued for what it should be. Just lots and lots of dumb money. Don't be fooled. Just because the fund manager has $1 billion doesn't mean he's brilliant or she's brilliant. It's amazing how dumb they are. But so the U.S. dollar is already priced in the rate hike, and they've priced it in since February. We still don't have it. And I look at that and I'm like, I'm not so sure we need that. But the low interest rate's not helping. But the theory is it should help keep the dollar low, but everyone keeps front running it. So I don't know. They do need to normalize, and I think if we want to get into an academic discussion about it, and I don't think this is the right time, but I think the big issue is not the interest rate level per se. It's the overhang of excess reserves at the Fed. And normally, right, what are the three Fed tools? Open market operations, discount rate, and what else? I'll let you think about it. The discount rate is a tool that the Fed uses to try to influence how much money a commercial bank keeps in excess reserves. Traditionally, before the great financial crisis, global recession that we went through in 2007, 2008, 2009, before that, commercial banks kept almost no excess reserves. Almost none. They lent out everything they could possibly lend out. Well, why not? We're a capitalist economy. They're in business to make money. And it's really important that they do lend the money out. To be a financial intermediary where they take the savings from one group of people that need a higher return, especially above inflation, right? And need to turn their money, which is, money is just money. They need to turn it into wealth. It needs to grow at a faster rate than inflation. But they don't have the skills and, the tools and experience to meet the challenges of making loans, right? The asymmetric information gap. So then you got to then give it to a financial intermediary by depositing it into a bank, and then the bank is supposed to keep 10% at the Fed just in case there's a liquidity demand, and the other 90% they lend out to those that need to borrow it, and they put the capital to work, and that's what creates wealth. Very nice. And because they would loan that out and make money on the loan, banks would loan out as much as they could, the remaining 90% if they could. When the Fed got worried about that there was just not enough excess reserves, what they would do is they would raise the discount rate at the discount window at the Fed, so when a bank needed to borrow money from the Fed, the interest rate would be so much higher than the Fed funds rate that a commercial bank would be nervous, like the manager of the bank would be nervous and say, well, if we had to go to the Fed, first of all, there's a stigma to it, having to go to the Fed. I mean, who wants to go to the Fed, right? And then if you had to go to the Fed, it would be so expensive that you're like, you know what? I think I'll keep a little excess reserves around just so if I do get hit with a liquidity problem, I never have to go to the Fed because A, I don't want to pay the money, and B, I don't want the stigma. So I'm just going to keep a little excess reserves around just as an insurance policy, just to avoid the Fed. But what do you do to get a bank to lend out its excess reserves? Well, lowering it just doesn't do it. It's like the Fed never needed that tool before. So, I think where the Fed is probably thinking right now is raise the interest rate even a little bit so that banks have more of a reason to loan it out. Right? So, all right, fine. So that's going to be their thing. But here's I think another issue, and again, we're getting way into the academics of this, but one of the things that the Fed decided to do back in 2008, 2009 was to pay interest on the deposits at the Fed. Okay? So one thing the Fed could do is just say, well, we're not going to pay interest anymore. They never did before. So if they did that, what would happen? Well, then if the banks just flooded the market with loans, I think interest rates would skyrocket to hyperinflation levels, and I think they realize that. So they need the banks to loan, but not too much. Real predicament if you're a central banker. And again, if you have no idea what I'm talking about, you need to take the fundamentals course, brother. All right, so GDP out of the out from the Kiwis. Yeah, that's going to be important. Are we going to get a good number? No, probably not. Why? Because they're cutting interest rates. So they already told us the number's bad. Okay. The stupid national bank, they're gonna lie to us some more. The interest rate is, how long are they going to keep interest rates negative, right? That's a big question, isn't it? So that could be tradable. But notice how we're getting closer and closer to the Fed. Okay. So what do you think's more important? Building permits or the interest rate decision? And you know, the building permits and stuff like that, there's lots of trend data there. We know what's going on. There's no surprises there. Weekly unemployment claims, not that big deal. Philly Fed, normally very tradable. It's gonna move for 7 minutes and then stop. It's all about the FOMC statement, press conference and stuff. So like I said, I've decided to put together a special event. We'll cover this live. All you need to do is open a live account at tradersway.com. Super easy process. Doesn't require a lot of time, doesn't require $1 million. And you'll be able to access the webinar from your Traders Way private office. Does that sound good, guys? I'll be there for you. These 5 words I swear to you. When you trade, I want to be there for you. Yeah. All right, Governor Stevens speaking. Sneaky guy, huh? He says, well, we'll wait for the Fed to make a move, and then I'll come out and make an announcement. Very nice. Okay. Yeah, going back to the Fed stuff, yeah, it's going to be a big one, guys. Super overhyped. Almost all experts have it wrong, or at least they're, I don't know, maybe talking their book or something, but whether they raise interest rates or not, it's going to be a giant move because there's billions of dollars gambled on the fact that the Fed raises interest rates. And probably a few $1 billion gambled that they won't raise interest rates. And then too much money already in the market with the assumption of raising interest rates. So if they raise interest rates, there's going to be a lot of people betting against it that are going to be caught going the wrong direction. There's going to be, right? But there's also going to be a lot of people that said, what? They actually raised interest rates? Oh my God. And everyone piles in and boom, boom, boom. And then there's going to be a giant snapback as, you know, whatever. It's going to be fun, man. It's going to be fun. A wonderful opportunity to lose money. But if you're smart and you're calm and you're focused and you do your homework right, there might be an opportunity to make money. So yeah, that's going to be a big day, obviously. And then back to the CAD, right? It's the sell the CAD Friday. Seems like every Friday we're dumping CAD. Marcia says profit taking. More like getting the hell out of the trade would be the better way to describe it, Marcia. My guess is they don't raise interest rates, and there's going to be a lot of people saying, "Go! Out, 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 out!" And that will pop the market, and then that'll hit some stops, and then bulls from the Euro USD will get in on the next pullback, and then goes up the next level. So we might start this at like $1.12 and end it at $1.17, you know, within a few days. Tico says big spike down and then up. It's all the same, my friend. Yeah, as long as they don't break your broker. Well, you know, when the Swiss National Bank came out with their lies and their deceit and their negligence, a lot of brokers got in a lot of trouble. And in fact, a couple of brokers went out of business. FXCM was froze everybody's accounts. and all that kind of stuff. And I contact Traders Way, and I'm like, "How you guys doing? Is everything good?" And they're like, "Yeah, we're good." I'm like, "But you're not caught anywhere. You're not freezing people's money. You're not caught with like $200 million in negative traders accounts, like FXCM." And they're like, "No, we're totally fine." I said, "You know what? You need to send out a press release because that's cool." I'm like, "I don't get it. So why is FXCM, $500 million in the hole, and you're perfectly fine?" And they're like, "Well, we're actually an ECN. Traders make a trade. It goes into the open market. We're not on the other side of that. What's the big deal?" Yeah, UK, Opari went belly up. So anyways, thank you, Traders Way. Thank you. Did their job well. So anyways, the markets are volatile, man. A lot of market participants now. So another reason, 3D globe of economic complexity. Cool, dude. Let me check that out. Right on, Alan. Oh, what's going on? Mouse problems. Hang on. I don't know where. Oh, here it is. I'll come to it later. Zoop. Oh, man. There we go. Zoop, zoop, doop. So that's the week as we know it. It's the start as the week as we know it. Looks like a good trading week. We got some nice news to begin the week, and it goes right up into the FOMC, so very good. Okay, but nothing should make the market jittery except obviously the Fed meeting. So another really good trading week should be really nice, but I believe trend friendly. Okay, I believe it's a trend friendly week, so that's good. You guys ready for the commitment of traders report? Well, Sebastian says, in relation to, why to be with an ECN, he says, a good reason not to be with market makers. But you got to go back to the history of the market and the need for market makers. And very often, there just wasn't enough of a market to trade. You wanted to sell, but you couldn't, or you wanted to buy, but you just couldn't. There was no market. So there was a need, in the beginning obviously it was floor traders, that market maker would be there and be the market. And this was in particularly important too for big commercial banks and stuff that would be the market for their clients. So imagine a commercial bank's got a client that does a lot of business in Brazilian high and needs to make a foreign exchange trade, either hedged position or just to convert, whatever. And there just wasn't enough high laying around. And there wasn't, there wasn't anyone else in the market that wanted to participate on that, be the other person on the other side of the trade. So what the commercial bank would do is say, okay, well, we'll take the high from you. You're a good client. We'll take it from you, and then we'll cut it up into small pieces, and over the course of the next days or weeks, whatever, they'll sell it off. You know what I mean? Yeah, it's high, not real. So anyways, that's what a market maker was. And same thing with the floor trader. If a big order came in and there just wasn't enough counterparty, then the market maker would take it and make that market. Okay. And when I first started trading Forex, brokers were market makers. And you needed them. Brokers were market makers. They held a book of trades. And most of the time, buyers and sellers would basically offset each other, especially in retail, right? But all of a sudden, what happened was everyone was short yen. So who's going to sell you more yen, right? So, right, nobody was buying yen, right? Everyone was selling yen. So brokers came in, and the first time I heard of a broker going out of business and the NFA getting involved was a broker called World First or Global One or something like that. And so the NFA shows up at the world headquarters of this broker that had hundreds of millions of dollars of Japanese yen short positions that they couldn't cover when the market collapsed. And so the NFA shows up and they guess where the address was? The world headquarters of this broker that had hundreds of millions of dollars in short positions that they couldn't cover. The NFA gets in their car, they drive to the address in their database. Turns out it's a dorm room at a university. Yup. They're like, maybe we should regulate this Forex thing. Yeah, no joke. There was a couple of kids running it out of their dorm room. NFA shows up and they're at class, so the NFA had to just sit around and wait. Bunch of college kids. Isn't that amazing? So Oren's, gets to the point here. COT data shows hedge funds chasing price, taking profits, and all that kind of stuff. And that's really it. And very often, the way I like to use it, again, fundamental analysis won't put you into a trade, but it'll confirm or deny what you see in your charts. And sometimes we'll see price is going up and up and up and up, but nobody's buying it. Well, how could that be, guys? If your price, let's say like the Euro USD, the Euro USD, let's say for 4 days in a row goes up 350 pips. But nobody's buying it. How could that possibly be? Joseph is exactly correct. Short covered. So what does that mean to you as a trader? Well, A, you shouldn't be buying the Euro USD. And two, if no one's buying, and it's only people getting out of their short, then at some point they're going to short again. And so when we were at, 115, 116, I did a whole speech, like a whole session about being ready to sell, about keeping your eyes on your fundamental bias, to trading in the direction you want to be in. I gave speeches about being the type of trader you want to be, that this was a test. Does anyone remember all of that? That now is the time to step up and do what you would like to do if you are only a professional, but you could just be that person now. Well, I'm sorry it's only dropped 400 pips, but we haven't even gotten to the event yet. So, I don't know. 400 pips is a start. Don't worry, you'll do better. No, James, USD yen is going to 130. Okay, Goldman, when I talked to them this morning, said euro was going down, but there's no price target, just down. And again, I'm like, dude, I knew that a year ago. So I hung up the phone. Amateurs. All right. So anyways, that's how I like to use the commitment of traders report. Really important. All right. So this red line, squiggly red line, is the price of Euro USD. Doop, 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 doop. So we had a big spike, right? And a decline again. Cool. The net market's a little more short than before. Cool, as expected. Anything dramatic? No. And so what occurred here? What made it happen? And that's why you need to use the COT. What made the Euro USD fall? Okay, no change. This is the gray line here, are bulls. This is people buying. And I think they track lot sizes of 1 million or more, right? And there's a lot of contracts here. But you can see almost no change, like no change at all. Nobody bought the Euro USD that week. Nobody, not Euro USD, sorry, Euro. Nobody bought the Euro that week. Nobody. But you see here, there's a reasonable increase in short positions. Nobody bought it, but the market started to short. Now you remember, this is data on the close of Tuesday. I bet you anything that the shorts have increased over that period even more. But fact is fact, according to this data, which was released Friday afternoon at the close of trading. This is Monday morning at the open of trading, right? So it's the next real day, right? And we know that nobody is buying the euro. Nobody. And the market's starting to short again. Is that relevant, important information? Yes or no? Well, thank you for being on my team. You make me want to be a trader. Piggy, 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 can't you see? Sometimes your pips just hypnotize me, and I just love those profitable ways. Guess that's why they're broke and you're so paid. Yeah. British pound, otherwise known as the piggy. Okay. So, British pound. Okay, it looks like it has fallen. Shorts have gone up. Longs have gone down. Net down, down. Very interesting indeed, yeah. I think it's a little lagging because it did rally up maybe right after this data came out, but and it is elevated as we already talked about. We'll go through the charts. John, easy question. Johnny sets me up. Johnny's teeing the ball up for me. Johnny wants to know, what do I expect the euro to rally when the Fed does not raise interest rates? Well, I'll tell you my opinion, but why don't we just talk about it? Do you believe market participants have already bought the dollar based on interest rates going up? And I'll wait for you, Johnny. This is for John Boy. Let's talk it out, Bubba. Okay, so you don't think anybody has bought the dollar in anticipation? In that case, nothing will happen. So John believes the market is calm, and intelligent and conservative. Cool. All right. Well, then nothing will happen, Johnny boy. I think you're crazy. John, are you highly educated? I bet you are. I bet you John's got a master's degree in what's your master's degree in, John? Something liberal, right? Some dead language or something. No? I'm just saying you're too smart. Yeah, communication sciences. My favorite one is, my major is in international marketing. Like, what the hell is that? Yeah, so that's what I'm saying, John. So I'm just saying you must be, highly educated because you're too smart. Right? You're like, that would make sense, John. Like, there's no reason why the Fed should raise interest rates. And even if they did, that's probably going to be closer to the end of the year. Okay, all of that's right. You're right, except you're completely wrong, most likely, because I don't know either. But the market is stupid, is my opinion. Now, I attend university. I'm a 42-year-old college student. And I learn about, how they teach trading. And they teach trading very much like you say, that, the market is smart. In fact, the market's never wrong. Right? And all that kind of stuff. And that there's just no way you can predict price action and all this stuff that goes on and on and on. And of course, it's completely wrong. But they assume the market is smart and intelligent and logical. And in my experience, it's the exact opposite. The market is stupid. The market is dumb. The market takes risks that are inappropriate. So my theory is the people have bought the dollar. They do want the Fed to raise interest rates, and they will find, if the Fed does not raise interest rates, they're going to find they're on the wrong side of the trade. And if that is true, I don't know if it's true, but if that is true, then the Euro USD would go up, because people would not be buying Euro, because we can see no one is buying Euro when we looked at the steep data, but they're buying dollar. And you'll notice, these are all talking about individual currencies, but priced in dollars. So, if it's coming down, if these charts are coming down, that means the dollar is going up. So anyways, the response would likely to be traders getting out of the US dollar that they bought in anticipation of the Fed, but the Fed didn't do what they thought, and therefore they're on the wrong side of the trade. Then the second part of the equation here is, well, if they were buying dollars in Forex, that means you have to sell something. So they bought dollars relative to what? Is a big question mark. Well, Euro is like 60% of the entire Forex market, Euro USD. So I think just by definition, Euro USD would most likely go up. Then what else have people been shorting? How about USD yen? I think USD yen would fall. And then, what? Let's talk about pound, baby. Let's talk about you and me, right? But, I don't know, right? It's just like, so those are your guesses. Right? USD CAD might move, but nobody really wants to own the CAD, right? And Aussie Dollar might move, but no one really wants to own the Aussie. Euro USD will move, right? But no one wants to own the Euro. It's just everybody getting out of that pound trade. And the cool thing is they'll try again in October. And the cool thing is they'll try again in December. And then they'll try again in February. So, cool, man. It's only money. And, John, you're too smart. You got to dumb it up, my friend. I used to think that the guys in charge, the wizard pulling strings, I used to think these guys are smart, and they're not. Like for example, two things that come to mind. One time I watched a Fed meeting. I think it was a congressional testimony that Bernanke gave. I watched the whole thing because that's what I preach, right? That you should be there and you should understand and you should hear from the man in charge. When the wizard is speaking, you should probably listen. So I watched the whole thing. And he said, let me be clear. If you think I'm going to raise interest rates, I'm not going to raise interest rates. No, actually, he said, if you think, was it tapering? He was talking about whatever was super important, right? I forget. I think he said, let's say it was the taper. He said, if you think I said that we will reduce quantitative easing, something to that effect, then you are mistaken. Let me say it again. If you think that I've told you I will reduce quantitative easing, then you're mistaken. Okay? In congressional testimony, written on the record, said in front of the cameras, all you had to do was be there, or actually read the testimony. And the Wall Street Journal the next day said, Bernanke says he's tapering quantitative easing. The Wall Street Journal said, Ben Bernanke's going to taper. But I was there. He said, if you think I told you I was going to taper, you're mistaken. And so what happened in the world of Forex? Did the market, and we're talking about now that we need the multi-billion-dollar funds to trade, to move the market, right? Did the billion-dollar funds trade the Bernanke testimony? Or did they just simply wake up in the morning, read the Wall Street Journal as they're eating their breakfast cereal, and then go to work and make the trade off of the Wall Street Journal? Was it the Wall Street Journal, or was it the actual testimony by the head of the central bank? The stupid, unbelievable market traded off the Wall Street Journal, which was completely wrong. And I learned that day, because it was like shocking to me. I was just flabbergasted. The market traded off the Wall Street Journal, and it told me that the guys in charge of billions and 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 billions of dollars are stupid and lazy and don't do the work. Well, there's nothing illegal about being stupid, but I learned something clear, that if you just read it, or if you were even just watching the testimony, it was there. So they traded the Wall Street Journal. So the market, in my opinion, is stupid. But also, now as a particular hedge fund manager, I don't want to say the guy's name, but he's like one of the biggest hedge fund managers in the world, and he was on CNBC. And I'm not saying he's stupid, but let me just describe how he was. And he was, I think he's the largest hedge fund manager in New Jersey. Anyway, so he comes out onto CNBC, and they're just having an intelligent interview. I think he was like one of the guest hosts for the day. And he swore a couple of times and then caught himself almost swearing a few times. And he just spoke like a street thug. He couldn't speak in a sentence in a formal environment without swearing and cursing. Like a common street thug. I'm like, what? This guy's got $100 billion? I mean, no joke, it might have been 500 billion, it might have been 900 billion. But I'm just like, really? Just like boiler room stuff, right? Boiler room stuff. You're like, wow, what a dinosaur. So, So anyway, so I'm like, well, that's what it's like. Those are the guys in charge. Yeah, so John's like, so smart money is stupid and lazy? Well, let's turn it around and talk about something positive now. If you do the homework and you put in the blood, sweat, and tears for years, you can make money on stupidity and laziness. It gives you a reason for being in the market. You can bring alpha. Okay? There's room for you, John. And that's good. To me, that's a very positive thing. Right? And there's 83 people in the room. If we all took 50 pips out of the market today, have we harmed anything? Like, are we just too big? We make the market inefficient somehow? There's just more than enough icing to go around, guys. Well, right now, actually, it's all cake and no icing because typically the interest rate differential, the yield that you were collecting on your trades if you're carry trading, was the icing on the cake, and it was thick, beautiful icing. Right now, there's very little icing. It's all cake, but, don't worry. If you look at Forex trading like maybe Warren Buffett would think of making an investment. Is Warren Buffett thinking about, if he buys a company, it's going to make money in the next 2 years? Is he thinking 2 years, 20 years, or 200 years? $20, even 200. Even 200, sure. Right? In the depth of the financial crisis, he made his biggest purchase ever, and it was one of the railroad companies. And he's like, look, the economy is going to come back. And there's only one way to move freight across the country, this giant country of 3,500 miles. There's only one way to do it efficiently and cheaply. You got to go on a railroad. So I'm going to buy it for $100 billion trillion. But it's just going to slowly and quietly make money for the next 100 years. That's it. He's like, I don't even worry about the price. Everyone's like, you paid way too much for it. And he's like, well, I don't really care. It's just going to make money every day. That's it. So, longer term. So I'd say look at your Forex trading over the longer term. What are you going to be doing 5 years from now? And Forex trading will be quite different 5 years from now. But that's all right because I'm experienced. What you're going to get 5 years from now, I used to do. Right? And I've been doing what we're doing now for probably about 5 years. It's been a long gig, man. So, the next 5 to 10 years, Forex trading is going to be quite fantastic. And sophisticated investors, when I first started talking to investors about putting money into Forex, it was very radical, because they had heard of it, but to them it was like the wild, wild west, and they'd say, wow, I don't know, I don't want to get into that, it's unregulated. Like, no, it's not unregulated. You're going off data that's 20 years old. No, it is regulated. Let me show you, and let me educate you, and let's talk about it. And so anyways, you spent a lot of time educating, and there was always an alternative investment. In fact, Forex is the alternative investment. So they're like, well, but my real estate keeps going up. Well, my stock market, portfolio keeps going up. Why do I need Forex? Right? That kind of thing. Now it's like, oh, well, your real estate's going down, and oh, well, your stock market portfolio is going down. Or, how about this? Your big smart MBAs at that big, wealth management firm, or your Goldman Sachs kind of guys called you up and said, get out of the dollar. Get out of the dollar. It's going to be worthless. You should buy lots of euro. So they drove the euro all the way up to, what, 130, 140? And then it crashed, right? So now there's a lot of wealthy investors that are holding all this euro, and they're like, dude, you totally screwed me on this. But investors have become educated, and they like liquidity. They like earning a yield, right? Why be in gold if you can't earn yield, right? All that kind of stuff. So it's nice. It's a nice alternative investment. Investors are much savvier and much more aware. But also as Forex being the alternative, the comparable investments are less attractive, right? For example, the stock market's been going up, 20, 30, 40, 50% a year for the last 3, 4, 5 years. What's the likelihood the stock market in the United States is going to go up 50% next year? Very unlikely. So these high growth years are gone, and it'll likely grow at more of a traditional rate of return. So if you got that, well, wouldn't you like to have some access to maybe a higher than the rate of return of a traditional stock market year? So like in 2016, let's say the stock market goes up 10%. You're like, well, I've been enjoying 30 or 40% a year. Well, what are you going to add to your portfolio to continue making that kind of return? Where can you pick up the additional stuff? And, well, maybe a smaller alternative investment. So I say, look, you got $100 million, just put $1 million over here in Forex. All right, so the world is wiser is what I'm saying. So if you can build a skill and have a longer term point of view, and sort of be aware and in tune with these slow sea changes, then you'll fit right in. All right, so USD yen was way up here. Remember, 125, then dropped to 120. We're still basically there now, right? Cool. So what's going to happen? Well, what's happening now is there's a slight net increase. Let's see why. The gray line are long positions. Did anyone go long? No. Did anyone go short? No. No change, basically. Just a slightly more bears. Okay. But nothing dramatic. And you see the market is basically neutral. This is the zero line here. So you could talk to an investor and say, well, look, when Goldman Sachs is giving their projection, they're looking at 130 on the USD yen over the next 12 months, and we're currently at 120. According to my research, the market is neutral. So if we can get the Fed to start raising interest rates and go through a contractionary cycle, or let's say enter into a contractionary or normalization process at the Fed, and Japan adds to quantitative easing, we'll have that perfect storm that will lift the USD yen by 1,000 pips, as Goldman Sachs said. The only thing is I'll do it cheaper for you than Goldman Sachs will. Because I'm not going to front run all your trades, and I'm not going to bet against you. Like. Aussie. Anybody buying Aussie? Aussie dollars dropped. Slight net increase, right? No change in bulls, and some of the bears have gotten out. Is this important? It is important, isn't it? Because we're at the psychological level. What? Isn't that important? And we were down there at 69 something, right? Now we're at 71. Cool. And you can see it's just people getting out of the short. Which means if things go as they may, the Aussie dollar could come down again. But like where? That when we hit 69, remember the tone of the conversation? I'm like, I don't know where it's going to go because Governor Stevens hasn't told us any different, right? He hasn't talked it down to 60 yet. Jimmy says, is the COT a lagging indicator? Absolutely, totally. And it's not really even an indicator. Okay, but I got this Friday afternoon, and the data is from Tuesday at the end of trading, what was reported. So they gather all the information from all the brokers and all the banks, right, at the end of trading on Tuesday, and they compile it Wednesday, Thursday, and Friday morning, and then they release it Friday afternoon. So yes, it's not real time. But these are very large positions. So this is Aussie dollar, right? So if you want short-term positions, I have them here on my chart. So this is the Aussie dollar, what we were just looking at on the COT. On the right here are buy orders in the market, and then on the left are sell orders. And I could see them in real time. So just above price, there's more than 90 standard lots. Just below price, there's only 25. So there's 90 above, 25 below. Where are the orders? Look, 20, 20, 90. You see that? 50, 50, 40, 70, 20, 50, 20, 20, 20, 25, 25, 50, 90, 90. Look over on the left, 22, 17, 90. You see that? 90, 90. Yeah, these are orders coming in, placing some money just above price. So that's real-time data. Yeah, anyone that opens up a live account as a live account to Traders Way, just take a screenshot of your private office, right? Take a screenshot of your PO, email it to me, and I'll send you the file to install. And it installs itself. So you download it as a zip, and then you open it up, and it says, you want me to install in your MT4? And you're like, yes. And you click a button, it goes boom, 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 boom. Done. Wayne at fxbootcamp.com. What do you think? Now, but you got to be careful, though. This is an institutional trading tool. You know, I don't know if you want it. 70, 90, 70, 70. Look, 70 versus 17. 90, 40, 50, 70, 70, 70 versus 17. 50, 40, 70. I believe it's in the intermarket, Felipe, because I don't believe Traders Way has clients that are trading billions of dollars in every few seconds. They're an ECN. This is the liquidity, right? So remember, an ECN, all it does is take your order and put it into the open market. So it has to look for liquidity, right? This is the liquidity. So this is orders coming in from, I don't know, Goldman Sachs and Bank of America and JP Morgan, Deutsche Bank. Yeah, these are orders. So Lewis says, am I training people on it yet? No, not yet. Because I don't have a ton of experience with it. I haven't been in an institutional, on the institutional side for very long. So watch it, observe it, pay attention. It might be totally awesome. It might be a total distraction. But the other interesting thing, guys, is if you're trading, you can set your OCO orders now. Right? You can set your OCO orders. Right? Your stop loss 50, take profit 50, and you could trade, quick trade off of, right? Just click that, it'll put you in with the 50-50 OCO. And then if you want to add another one, you add it, add a third one, add a third one. Your volume will go up, your floating profit and loss will be here. And you don't have to have your, your little, what do you call this thing? A little window open. It just takes up too much real estate, right? So you have that there, and then check this out. They have a close all button. So you can just get out of all your trades. So if you're scalping or you got a little basket going on and you're buying all the dips, buying all the dips, buying all the dips, it's throwing down your stops and your limits on each individual trade, and then you get to a weekly reversal pivot point and you just click a button, go close all, boom, you're out. Sweet! I'm the greatest trader in the world! Okay. Cool. So I've gone on too long, so why don't we call it a day? I'll see you tomorrow. Peace on earth. May the pips be with you. May your profits be above average. Thanks for being on my team, eh?